Now let's move on to valuation. Broadly speaking, we have three valuation approaches: an asset value based, price multiple comparison based, and discounted cash flow based valuation. In this section, we are going to focus on asset value based valuation. When we talk about the value of assets, we can either take a book value perspective or a NAV perspective. Book value per share simply looks at accounting book value on a per share basis, and this generally is not used with REITs because there can be a substantial difference between accounting book value and the fair market value. So the relevant metric is NAV PS, which stands for net asset value per share. You've also heard the concept of NAV when we talked about mutual funds in level 1. Now NAV is based on market prices or fair value, so that's why this is more relevant. When REITs sell on the stock market, the shares can trade either at a discount or a premium relative to NAV, and we'll talk more about this in subsequent sections. However, the net asset value per share will be the largest component of intrinsic value, and hence it is a key element to estimate when we are doing REIT valuation. Section 5.1 talks about accounting for investment properties. Now there are just a few core points over here. Under IFRS, companies are allowed to use either the fair value model or the cost model. As analysts, we obviously need to understand which model is being used. If a company is using the cost model, then we need to get the fair market prices and use those market prices when we calculate NAV. If a company is using fair value, then obviously we have a better starting point. But as analysts, we should still understand what assumptions have gone into coming up with this fair value. US GAAP does not distinguish between investment properties and other long-term investments. Generally, companies that follow US GAAP will report based on historical cost. So there it is essential that we determine market prices and use those market prices to come up with NAV. Here we'll talk about how to calculate net asset value per share. This is extremely important and very testable. So the starting point is the last 12 months real estate net operating income. We then reduce non-cash rents. Now the idea here is to remove the impact of straight lining. Let's just understand what this concept of straight lining means. Lots of real estate leases are long term, and you have a situation where rents might be increasing by 3%. So in a 10-year lease, the lease term might be that rents will increase at 3% per year. So if we look at rents on the y-axis, rent per year, and the time on the x-axis, given an exponential increase, rents will go up roughly like this. Now, accountants don't like anything that is non-linear. So what they do is make a straight line estimate. So based on this straight line estimate, the reported rent income will be more than the actual cash received. Now, the process of creating this straight line approximation or linear approximation is called straight lining. And since we are concerned with the actual cash, we want to remove this impact. And this is called removing non-cash rents. Effectively, this is bringing us closer to the actual cash received. So we remove the non-cash rent. Next, we make an adjustment for full impact of acquisitions. So if during a given year acquisitions are made midway through the year, then our rental income will only be the rental income for half the year. Since we want to estimate the full year's income, because this property that was acquired here now will be available to us in the future, so we make an adjustment so that the full impact of the acquisition is realized. After these two adjustments, we have the pro forma cash net operating income for 12 months. Then we compute the next 12 months growth in net operating income and estimate the next 12 months NOI. So if we have come up with a number of 100 over here and we assume that the net operating income is growing by 5%, then the estimated next 12 months net operating income will be 105. And the reason for doing this is very basic. I'm sure you remember this from level 1. If you want to value an asset at time t, you want the cash flow for the upcoming period. So that's what we've done. We've estimated the next 12 months growth with 5%, come up with the 105, which is the number over here. Cap rate, let's say that cap rate is 10%. Estimate the value of the operating real estate, that would be 105 divided by 0.1. And then we add our basic hard assets, tangible assets, cash and equivalents, land held for future development, accounts receivable, prepaid, and other assets. And this is what gives us our asset value. Note that we do not incorporate intangible assets because there is too much subjectivity involved there. And then we subtract debt and other liabilities, and that will give us our NAV. We then divide NAV by the number of shares outstanding, and that gives us NAV per share. Very important calculation. There is a good chance that this shows up on your exam, so make sure you are on top of this. Section 5.3 talks about the application of NAV. The first general point is that NAV is extremely popular and is used by many different kinds of investors. An important point to understand is that the net asset value reflects the value of REIT assets to a private market buyer. So essentially this NAV model is based on valuing private property. So it's a private market perspective, but a REIT is a publicly traded share. So a public equity investor's perspective might be very different. Typically, a public equity investor is forward-looking and he will be considering the asset values, but in addition, he'll look at several other factors. For example, the quality of the management team, the outlook of the economy, and so on. And when a public equity investor considers these other forward-looking aspects, the valuation that he might come up with will be different from NAV. And it is largely for this reason that REIT shares often trade either at a premium to NAV or a discount to NAV. It is unusual to find REITs that are trading exactly at NAV. Another point to consider is that REIT valuation essentially is looking at a static pool of assets. So effectively the method is that in a given REIT, let's say that there are 3 different office buildings across different parts of the US. In a REIT method or in the NAV method, we are effectively coming up with the value of each of these static assets and adding them up. One issue with the NAV method is that if transaction data is limited, then we'll have a questionable NAV number because our cap rate then will be questionable, and hence the value that we come up with for our operating assets will not be quite reliable. And finally, 2 concluding points in this segment. REIT investors have liquidity which private investors do not. And because of this, all else equal, the required rate of return or the riskiness of a REIT is lower compared to private investors in real estate. Again, this is all else equal. Another point is that REITs are likely to have above average management teams because these are public securities, and generally public companies tend to attract better management, and that again is likely to reduce the riskiness of a REIT. So we've covered the core points now related to NAV per share. There are no examples in this section, which is uncharacteristic, but later on in this reading there are several examples that tie back to the concept of NAV. In section 6 we talk about the relative value or the price multiple approach. Now there are three multiples that are talked about in this section: P over FFO, which is the price to funds from operations, and then price to adjusted funds from operations, and finally enterprise value to EBITDA. Enterprise value to EBITDA is not used very often, and the curriculum doesn't spend much time on it. It is also not mentioned in the learning objectives, so I will not talk about this. Instead, we will focus on these two. The three main drivers behind these multiples are as follows: expectations for growth in funds from operations or adjusted funds from operations. The point here is that if we expect relatively high growth, then that obviously will result in a relatively high multiple. And this is often based on geography. So if you have a REIT that owns properties in places like London or New York, where expectations about increases in rents are higher, then obviously the growth expectations will be more in these regions, which will result in higher multiples. Second point has to do with the risk associated with underlying real estate. So if the risks are relatively high, so for example, a REIT that owns hotel chains is likely to be more risky than a REIT that is focused on apartment buildings. And a higher risk will result in relatively lower multiples. And finally, risk associated with capital structure and access to capital. Here again, relatively high risk will result in relatively low multiples. And the point here with capital structure is somewhat straightforward. Obviously, a company that relies heavily on debt, so if leverage is relatively high, then access to capital becomes difficult and risk levels are high. So from an exam perspective, you need to make sure that you know these three drivers. In this section, we talk about how to calculate FFO and AFFO. Now, the high level point is that funds from operations is a rough measure of the cash flow being generated by a REIT, and the calculation is fairly straightforward. We start with the accounting net earnings. So remember, a REIT is essentially a public company, so it will have an income statement. We start with the bottom line of that income statement, which is the accounting net earnings. We add back depreciation. We remove the impact of deferred tax charges because these are non-cash items, and we also remove the impact of gains and losses from sale of property and debt restructuring because again these are non-cash items. So after these adjustments we have the funds from operations. Now a slightly more refined form of the FFO is adjusted AFFO, and you need to know this formula also. The adjusted funds from operations is equal to the FFO minus any straight line adjustments. Now you might remember my example earlier where I talked about straight line adjustments, where if this is time, this is rent, then the accounting assumption is that rent is increasing linearly, whereas in reality there might be a non-linear increase in rent. So these differences need to be adjusted. This is called the straight line adjustment. The point is to get closer to the actual cash flow. We also subtract any recurring maintenance type capital expenditures. So for example, if a REIT owns apartment buildings and we are re-roofing the apartment buildings, then that would be a maintenance type capital expenditure. That is a cash expenditure. Similarly, lease commissions are cash expenditures, so we need to adjust these out to come up with AFFO. So this is a better measure of the cash flow, and the curriculum points out that the AFFO is a better measure of the economic return to shareholders. Now you need to do examples 6 and 7. Now let's take a look at the advantages and drawbacks of these multiples. The advantages are fairly straightforward. These multiples are widely accepted in evaluating share prices. Now, given this wide acceptance, portfolio managers can put REIT valuation in context with other investment alternatives. So very roughly speaking, these multiples can be compared with price earnings multiples or price to cash flow multiples. So portfolio managers, when they are talking to their clients, can compare REIT valuations with the valuation of stocks. FFO estimates are readily available. So as you will see in section 8, which gives us a mini case, the REIT that we talk about in section 8 actually shares its funds from operations. So these numbers are widely available, so it is relatively easy to come up with these multiples. And finally, the multiples we are talking about here can be used in conjunction with growth rates and leverage levels for relative value analysis. Now, simplistically, this means the following. Let's say you are evaluating two REITs, A and B. Both have the same price to AFFO multiple. Let's say that the leverage level is also the same for both REITs, but the growth rate of A is more than the growth rate of B. So REIT A is expected to grow at a faster rate, or the FFO is expected to grow at a faster rate. This would mean that on a relative value basis, A would be a better investment. Moving now to the drawbacks. These multiples do not capture the intrinsic value of all real estate assets. The point here is that if a given REIT owns lots of land, we need to make adjustments to multiples such as price to FFO for any vacant properties. So if without the vacant property you have a given multiple of say 10, then when we factor in the vacant property, this multiple should be adjusted upwards before it can be compared with say the multiple of another REIT which does not have vacant property. Next point, this multiple price to FFO does not adjust for recurring capital expenditures. Now, if you remember what we covered on the last slide, the adjusted FFO does address this issue, but there the slight problem is the assumptions involved. So when we use AFFO, this problem is addressed, but we still need to be careful about the sorts of assumptions made. And if we are comparing this multiple across different REITs, we need to evaluate whether the same assumptions are used across the different companies. In recent times, there have been several one-time gains and losses, and this has skewed the accounting numbers to an extent which makes it difficult to compute the price to FFO and price to adjusted FFO multiples, and it also makes it difficult to compare these multiples across different REITs. And now the discounted cash flow approach. Since REITs and REOCs generally pay out most of their income to investors, the dividend discount model works quite well. Typically, investors who are valuing REITs and REOCs use a 2 or 3 step DDM. This is where for a few years you might have relatively high growth, and then after that the growth stabilizes at a lower number. You have seen this in level 1 equity and then again at level 2. So I'm sure you don't have any issues doing dividend discount model based valuations. An important point to consider is the growth rate. Here are some basic considerations. First, internal growth potential. So this basically talks about the growth potential of the cash flow or the FFO. If the REIT owns properties in supply constrained areas such as downtown New York, then the potential for increases in FFO and hence high growth rate is relatively high. Second point is investment activities. Generally, development-oriented REITs that are making several investments are likely to have relatively high growth rates. Capital structure is a slightly tricky item because relatively high leverage implies the ability for a REIT to grow faster in the short run, but generally REIT investors are conservative and prefer lower leverage. So this, as I mentioned, is tricky. And finally, retaining and reinvesting portion of cash flow. So if we see that a REIT is successfully reinvesting some of its cash flows, then that would contribute to higher growth. Now do example 8. Section 8 is a mini case study on REIT valuation. It is extremely important and it integrates what we've learned in sections 5, 6 and 7. There isn't anything new, but essentially the concepts that you have learned in these sections are applied. We are given a fictitious REIT and the financial statements are provided along with some additional disclosures. We are given the FFO and the AFFO, and then the three methods, NAV, price comparison, and discounted cash flow methods are used. Each of these methods give a different value, and that actually is done deliberately to highlight the fact that in the real world these methods are unlikely to produce the same number. And essentially what an investor should do is then either go with the method that he has the greatest confidence in, where the assumptions are most likely true, or use some sort of weighted average of the values obtained using the three methods. Example 9 then tests you on this case study. So again, from an exam perspective, I think this is very important. And then do example 10, which again tests on valuation plus some other concepts learned in this reading. Let us now summarize the main points from this reading. Our focus has been on REITs, and we have also talked a little bit about REOCs. Let us review what we mean by a REIT. A REIT is an entity which owns and operates real estate properties. And typically, a given REIT operates similar real estate properties. So if we have an office REIT, then these various properties will be office buildings of different sorts. The REIT issues shares or units, and shareholders essentially buy these units and indirectly then have an ownership stake in these underlying properties. When these shares trade in a public market, so they trade on an exchange, then this is called a publicly traded REIT. And that again is the focus of this reading. REITs are called tax advantaged because of something special about REITs which doesn't happen with other regular corporations. With REITs, the income that comes from these properties is tax deductible, and this is a huge advantage because this means that effectively the corporate tax on the REIT is very low. With a regular entity, the interest payments are tax deductible, but the money that is generated from the business, and then if any dividends are paid to shareholders, those dividends for a regular corporation are not tax deductible. But for a REIT, these payments that come in from real estate properties, when they are transferred on to the shareholders, then this payment is tax deductible. So essentially what is happening here is that through the REIT structure, the double taxation problem is addressed. The taxes are paid here by the REIT shareholders. REOCs, on the other hand, do not get a tax advantage. So REOCs essentially are real estate operating companies and they pay corporate taxes like any other entity. Given the tax advantage of REITs in parts of the world where this tax advantage does exist, we will find REITs rather than REOCs. In countries where REITs do not get the tax advantaged status, there we will also find REOCs. You need to understand the main investment characteristics. The big one for a REIT is the tax advantage, and other characteristics which should be obvious from this picture are the fact that a high percentage of this income that is coming from the various properties is transferred to shareholders. So there is also a relatively high degree of predictability as far as payments are concerned. Unlike private real estate investments, with publicly traded REITs, the liquidity of the ownership stake is also much higher. There are other characteristics that are described in the curriculum and in the regular lecture, but these are the most important ones. In terms of disadvantages or negatives, it turns out that the correlation between the returns of REITs and the returns on the stock market are quite high. So the diversification benefit of holding REITs rather than having a private stake, the diversification benefit is relatively low with REITs because of the high correlation with the stock market. You need to recognize that there are several types of REITs. I have already alluded to an office REIT. This means that the REIT owns and operates office buildings. We can also have retail REITs and so on. Essentially, the REIT is categorized based on the type of property that is owned and operated. The curriculum talks about each of these in a little bit of detail. I would say that you need to know one or two lines or one or two main aspects of each of these different kinds of REITs. A larger point is that all these different types of REITs depend heavily on the economy. So when the economy does well, then all these different kinds of REITs tend to do well. After that, the second most important characteristic will typically vary from REIT to REIT. With office buildings, for example, a big item is job creation. With retail, population growth, demographic factors have a major impact, and so on. Valuation is important, and there are several ways of valuing REITs. One method is to use the NAV or net asset value. The NAV is the market value of assets, which would be these underlying properties, minus the market value of debt. NAV on a per share basis would be the overall NAV divided by the number of shares which have been issued. The next question becomes, how do we calculate NAV? One way is to use the appraisal values. If appraisal values are not easily available or not completely reliable, then we can also compute the net operating income. And we talked about this concept in the earlier reading. And then this net operating income can be capitalized. We can also do valuation based on price multiples, and the concept here is similar to what we talked about in equity. It's only that the multiples are slightly different. The relevant multiples or the frequently used multiples in the context of REITs are price to FFO. FFO is a measure of cash flow. This would be roughly analogous to cash flow from operations. And in the lecture, we've talked about how to come up with FFO. We also have a ratio called price to adjusted FFO. The adjusted FFO is the FFO with some adjustments, as the name implies. Given both these ratios, the more appropriate ratio generally is the price to AFFO. And in some instances, you might also see enterprise value to EBITDA being used. We can also do a discounted cash flow based approach where essentially we estimate the cash flow in the future, determine the appropriate discount rate, and then discount back. I'm sure you have done this enough times, so the concept is similar to what you have seen before. That is it. As always, I want you to read the summary, review the learning objectives, do the examples. Make sure you do the case study that is described at the end of the reading and the associated examples as well. carefully do all the practice problems, and if you have time, also do practice questions from other sources.